What's up you guys, Tommy Shaw here. On today's topic, what I'll be talking about is how the Fed central banks manipulate the market. Okay, so first of all, how do they artificially keep interest rates low? They buy government bonds through the process of quantitative easing. When they buy these long-term bonds, what they essentially do is that they lower the yield curve. Instead of having a 3% or a 5% yield curve average, they push it down, and this has an effect on increasing the net asset value of assets. The whole process of how this happens is that if you take free cash flows and you do it to infinity, and you divide it by the weighted average cost of capital, if you decrease the cost of capital, it increases the net asset value. So essentially, the government is manipulating the bond market to decrease those interest rates, because naturally the market wants to correct. It wants to go up because it doesn't perceive that it has any collateral that is good out there. So what the Fed does, it goes out there and it buys these MBS, these government bonds, and it also does a repo lending to put liquidity in the system to keep from these interest rates from rising drastically. Because what we saw in last September, that rates started to increase by 10%, the overnight lending, because people were afraid and they didn't want to lend to other banks because they didn't perceive that it had any good collateral. Okay, so the impact is that it reduces the cost of money. It lowers the cost of money. So businesses can increase the value of their assets, and they can take on new loans. Houses usually inflate, vehicles start to inflate. We also see it in bonds, because if you reduce the yield, that means you increase the value of those bonds. Now it also goes into stocks, because the whole process of putting money in the system or lowering or giving it to these institutions, what they buy essentially, these pension funds, they're buying stocks, bonds, anything that can give them a yield or expected returns. Now, manipulation decreases the value of assets, which increases leverage. Because imagine if there's an asset that can give you 10%, you only need like 50% leverage to get a 50% leverage, 50% return on equity. But if you have an asset that is now giving you 5% because the market is over leveraged or the market is in a bubble, those return decreases. So you have to take on more debt to increase that return on investment. Example, if we look at the price earning of the S&P 500 right now, it is at 24, and the average is usually around 15. What does that mean? That means that the yield is approximately 5%. For all the risk that you're taking, 5% return is very low. The only reason they stay that high is because the government, central banks are behind the market, and every time it wants to fall, they go and they create artificial demand for stocks, bonds, which isn't true. Okay? The consequences is that it creates massive bubbles. Like the only way to get a return, because when you have massive bubbles, the next investor is essentially giving free money to these businesses. Because if you're only hoping not to make money on the money you invest, but you expect that the price of shares will increase in the future, essentially it's the other investor that's buying it in the future that's paying you. There's no real return from the company, because the company has almost no profits, and if it does have any profits, it's reinvesting to grow that business, because it's a growth stock. Right now, what we've seen in the last 10 to 12 years is that growth stocks have been outperforming value investment stocks. Why? Because people are no longer looking for fundamentals, they're looking for these growth stocks, which creates this everything bubble. Okay, so a little recap. How does the Fed, central banks manipulate the market? They artificially keep interest rates low. How? Through repo, through quantitative easing, which decreases the yield curve. They can manipulate that yield curve depending on where they buy throughout the spectrum. If you want to reduce 3 months, you'll buy 3 months. If you want to reduce the 30-year bonds, you'll buy 30-year bonds. And the higher you pay for the bonds, the lower the yield. You could bring that to zero. After a while, you can go into negative interest rates, but right now, we're talking about zero. This has an effect on increasing net asset value, because if you keep free cash flow stable and you decrease the cost of capital, then it increases the value of those assets. Alright, and increase the value of assets, the impact, the cost of money lowers, businesses can borrow more money, they can buy their own shares, which happened in the last 10 years. Businesses were not growing, they were not going outside their companies, they were buying back their shares. The problem with that is that if you buy something at a very high price, that's going to come, in the future, it's going to come back and bite you, because when market starts to correct, your shares will be worth essentially nothing. Then you leveraged all that money to buy shares that are no longer valuable compared to what you paid for them. Now, this inflates housing, stocks, bonds, asset prices. The manipulation decreases the return on assets, so it forces investors to borrow. But you're just making the situation worse, because if you borrow more in an inflated bubble, then you're creating another bubble, and if it bursts, you're left with no equity, almost bankruptcy. It's almost a certainty that the company will go bankrupt. Maybe that's what they want. Maybe when the business is no longer good, they squeeze it to the maximum, and then they say, okay, time for the next one. Example of this, the PE ratio, it's usually around 50, now it's 24. So it's still high when you're looking at a yield of 5%. I know bonds are very low, so since this yield is very low, it forces you to borrow to get a better return. The consequences, it creates massive bubbles in the market, housing, auto loans. As we could see, auto loans when I was in 2008, cars were like half the price they are right now. People say there's no inflation, but I see that the cars have doubled in the last 10 years. Student loan debts, a lot of people have debts in their student loans, because if it's essentially free money, you're gonna take on those debts. Bonds, high leverage, yeah, everything bubble. So if you like this kind of information, leave a like, you can subscribe, and I'll be seeing you on the next video. Thank you.